Home prices nationwide are going down. The latest October 2022 Case-Shiller U.S. National Home Price Index showed a continued decline of about 3% from its peak value. Month on month, it's less, only about a 0.8% slide. Yes, there is a downward trend, but hardly a head-spinning crash that everyone's prognosticating. There's a ton of fear-mongering out there predicting a complete meltdown and claiming that the housing crash is already here, or even calling it the Great Collapse of 2023, or the collapse in the mother of all bubbles. Bold, blaring, loud, and often unfounded headlines such as these, of course, attract a lot of YouTube traffic. But are these claims supported by real data? Well, let's have a look. Here is an alternative to the Case-Shiller Index from the U.S. Federal Housing Finance Agency based on sales prices and appraisal data. And it does not report any decline in home prices. This chart is based on the U.S. Census Bureau data. It too reports no drop in home prices. On the contrary, we observe here a slight increase in home prices for the latest reported period. What? How is this possible? If you've been paying close attention to the housing market trends in your neighborhood or town, you may be seeing a different picture. So how is it that these indices are seemingly in conflict with what you're observing on the ground? Well, first, and probably most important, all of these indices, which are artificially created averages or measures of central tendency, often unitless, are designed to provide a general sense of broad movements in a sea of individual data points. Second, not only that these indices measure averages, they do so over a huge number of nationwide observations. And while there are benefits to be reaped from large-scale data, the most obvious cost of a single nationwide index is that you clump together vast and very diverse property markets from sea to shining sea. That's why in every episode of my market report, I examine very detailed property sales data from a local source. Third, all of the above indices suffer from a significant time lag. The Case-Shiller Index, for example, is a 3-month moving average, and as such, it's published with a 3-month lag. In a fast-moving market, 3 months can actually be pretty significant. In fact, in our practice, when my partner and I are asked to produce a CMA, a comparative market analysis for a house, we rarely go beyond 3 months, unless the market is changing very slowly or there aren't enough comparable data points for the subject property. Let's now look at maybe more up-to-date, albeit also nationwide numbers. Redfin reports a drop in the median home prices from a 14.9% year-on-year growth in May 2022 down to, still a positive 1.2% growth in December. In other words, year-on-year prices still went up, but they're down from their peak. Curiously though, Zillow, on the other hand, shows no decline in home prices at all. So, per Zillow, the median price continued to go up, only at a much slower pace. When measuring the health of the housing market, it helps a great deal to look not just at home prices, let alone broad averages thereof, but also at the so-called macroeconomic determinants or factors affecting the supply and demand in the housing market. I won't go over many, just a couple of the most important ones. Currently, these factors are putting a downward pressure on the housing prices, unfortunately, or fortunately, depending on which side of the market you belong to right now. For starters, the likelihood of an impending recession has grown noticeably in the past few weeks. While the Dow Jones Industrial Average and S&P 500 remained largely flat, Nasdaq gave back a whopping 7.5% in the past 6 months. Investors are nervous, especially bond investors. Stock investors, well, they care about the performance of stocks, while bond investors are generally more concerned about the health and direction of the overall economy. However, according to the New York Fed's brand new Corporate Bond Market Distress Index, or CMDI, bond investor stress level came down a bit in the past few weeks of 2022. And then there's this yield curve inversion, which has been a particularly accurate predictor of recessions. The yield curve has predicted every recession since at least the 1960s. The spread between the 10-year and the 2-year Treasury note has been negative, actually pretty deeply negative since July 2022. I don't want to digress too much, but you can read up on the yield curve inversion by clicking on the link to a brief Financial Times explainer in the comments below. And finally, while the 3.5% unemployment rate is still near the lowest level in decades, some industries, such as tech and finance, are beginning to lay off workers by tens of thousands. Although it may not appear too much for an economy with a labor force of 165 million, it is certainly a trend worth keeping an eye on, as employment and GDP are closely related. Second, the interest rate is much higher than it was a couple of years ago. The U.S. average 30-year fixed rate has climbed from the bottom of the pit at 2.65% in January 2021 to 6.13% right now. Yes, the interest rate came down from the recent high of 7.08%, but it's a lot higher than it was in the recent rosy past. However, as I've said in a previous video, while 6% is well above the decade average, it is really not freakishly high. In fact, it's relatively close to the 25-year average, which is 5.18%. Now, 2.65% is the lowest 30-year fixed average interest rate Americans have ever seen. So you can decide on your own which of the two rates is the deviation from the norm. However, the Fed isn't done with rate increases yet. Jay Powell acknowledged that the restrictive policy can cause pain with delay, but stressed that
ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Okay, now again, it's time to get my microscope and to analyze the granular local data. And even though these data are specific to Palm Beach County, Florida, the very detailed, individual level, real transaction nature of these data help us see the incredible, fascinating patterns in minute detail and make out the trends that are easily generalizable to the rest of the country. By the way, it's worth mentioning that my data set has grown to almost 300,000 observations, which is great because such a large data set helps ensure statistical robustness. This is a chart showing housing price trends in the Palm Beach County in the past year. The median price of single-family residences in the Palm Beaches continued its downward slide last month, from $610,000 in November to $575,000 in December 2022, or 5.75%. This is $100,000, or 17% below its peak value of $675,000 just 6 months ago. But if we roll back another 6 months, $575K is actually 3% higher. In December of the previous year, the median sold price of all single-family homes in the Palm Beach County was under $560,000. Roll back even more to December of 2019, to the air quotes, carefree time before the pandemic. This median was just $380,000. It's kind of hard to believe, but there it is. So the median price of $575,000 is lower, much lower than its June 2022 peak value, but still more than 50% higher than only 3 years ago. Townhome prices also dipped down, but not by nearly as much as prices of single-family homes. The month-on-month drop in the median price of townhomes was 1.4%, settling at just under $386,000, which is 6% below its peak value of $410K in May, but 15% above the price of $335K a year ago. And do you know what townhomes used to cost in the Palm Beaches in December 2019 on average, or median to be more precise? Are you ready? Okay, so the median price of townhomes in the Palm Beach County at the end of 2019 was $245,000. That's 57.5% above the current prices. And finally, condo prices actually came back up a little recently, from $327,000 in November to $335,000 in December. Still, 13.4% lower than at the zenith in last April. Again, rolling back to just before the pandemic time, the median price of condos in the Palm Beaches was $219,000, or 53% lower than today. Days on the market is our measure of the comparative strength of supply versus demand in the housing market. I know what you're looking at.
Your chair, Dr. Evil.
Thank you. Whoa!
How do I explain this weird September 2022 spike in DOM? I mean, the December DOM is a normal-looking 32 days, below the historical value, but well above the feverish pandemic figure that dipped below 10 days. What's the deal with the September-October skewer? There are several possible explanations. First, the interest rates. Look at how the 30-year fixed rate, which was relatively stable at around 5% from the late spring to August, shot up to above 7%, the highest rate we've seen in 20 years. That must have spooked a lot of people, and I don't blame them. This Mortgage Bankers Association chart shows a steep decline in mortgage applications right around the start of the new school year. Speaking of the school year, there's a certain layer of population that tries to time their home buying to settle in at their new home before the start of the school year. You know, not to have to deal with the stress of closing and when kids are getting adjusted to their new classes and schedules. And finally, it was right around that time when a lot of people were talking about a potentially deep recession in the coming year. And right around that time, the stock market suffered deep losses. Those fears receded somewhat after better than expected business earnings reports and the continued resilience in the labor market. But as I've mentioned before, a recession, probably a mild one, is still expected this year, although a more painful one cannot be ruled out. Normally, historically, only about 6 or 7% of properties sold above their asking price. This figure skyrocketed to 42% in April 2022, and then nosedived to a near normal 9% in November. before going back up a little to 15% in December. I think it's worth mentioning here that many of these indicators will likely see some, hopefully small, adjustments in the following months or two. And that's normal. That's because it takes time for closings to happen and for these closings to be reported in the MLS. So, for example, days on the market are usually initially biased down, because the proportion of those homes that are destined to languish on the market for many months and aren't yet done pulling up the average remains high for the most recently listed homes. It's normal for home sellers to initially ask for more, to test the market, so to speak, and then be hit by the reality and adjust their list price. Historically, this number has hovered around the 44% mark. Then the pandemic happened, when only 15 to 20% of listings were deemed overpriced and had to bring down their price. The turnaround point happened around April-May of 2022, moving this indicator back towards its normal range, but in the latest 3 months, we're seeing a reversal, down to 28% in December. If you've been wondering how many home sellers are willing to negotiate the final price, this chart says that most sellers do. The historical average is at about 83%. Of course, during the pandemic, less than 2/5 were open to price reductions. Sellers reigned supreme in the residential property market. But the curve turned back up in late spring of last year, heading towards the normal range, until that strange reversal again in the latest reported months. This reversion to the pandemic averages is observed across indicators in the latest months. Here, take a look. Days on the market has swung around. Percent over ask is creeping back up. Fewer sellers are offering price reductions, and fewer sellers are willing to negotiate the final price. Why? What is happening? It's as if we're headed into a new pandemic. Well, the most likely explanation for this is that December inventory has always been an aberration. Take a look at this chart. It shows that in the winter holiday season, that's between Thanksgiving and the New Year, people are just too busy to list their homes for sale. It's a festive time. People spend more time with each other, plan big dinners, shop for presents, clog roads and airports in the quest to see family and friends, and even try to rekindle old relationships. And plus, kids are out of school. So new listings in December tend to take a deep dive. But almost invariably, it's followed by a sharp rebound in January. I expect the same to happen this year. Come back next month for a new episode of my market report if you want to see if I'm right. And finally, the share of cash purchases. This indicator has hit the highest level in my data, which go back 6 years to January 2017. What's the main reason, you ask? I have two most likely possibilities. The first, and most obvious reason is higher interest rates, tipping the balance towards cash buyers and investors. And second, we're still waiting for more complete data on the most recent closings. One last thing. As I've mentioned previously, there is a huge deal of seasonality in cash purchases. They tend to go up in the first quarter of every year and bottom out in midsummer. Take a note if you're thinking about listing your home soon, because this indicator, combined with the number of new listings, days on the market, percent sold below list price, the current mortgage rates, and other important intel can mean a big difference in your final take home. Talk to your local realtor for specific advice. This is all I have for today. I hope to see you again soon next month. Matane.